We just completed two key sections. We completed our section covering demand and total revenue concepts. We looked at demand in depth with respect to what drives demand, total revenue being price times quantity, and then we looked at production and costing, what we need to produce, capital, labor, and how those can drive our costs. So now we're going to look at the concept of profit. To do this, we need to determine how companies are going to price their product. And pricing their product is going to depend upon the market structure. So let's take a look at the roadmap of where we have been and where we are going. So we've already discussed the demand for a good or a service. We have examined the production and costs associated with producing or supplying a good or a service. And what we need to do now is look at how to price the product that we are producing or the service that we are providing and how to determine our profit. So pricing of a product will depend on market structure. When we say the term market structure, what economists refer to is the number of buyers and sellers in the market. So based upon the number of buyers and sellers in the market, this is going to, in large part, tell us how much ability the business has to decide the price of a good or a service. The ability to decide the price of a good or a service is called market power. Okay. So we're going to look at number of buyers and sellers, and we're going to look at the market power of the firm. Next, we have the level of product, of differentiation and uniqueness. So we want to know if there are any substitutes for this product. And that becomes important because if there are substitutes, then we don't have that much market power because the buyers can go to somebody else. So we want to see the level of substitutes. A fourth thing that we look at is how easy it is to get into this industry or how easy it is to get out of the industry. We call this ease of market entry or exit. And so, for example, when I say ease of entry, what I'm referring to is how hard is it to start a business? So, for example, if you're going to open a restaurant, that's pretty easy compared to other types of businesses. You need your building, you need your food permits, probably a few licenses, and you're on your way. But if you wanted to open up like an auto manufacturing company, that would be a lot more difficult because you would need very heavy equipment to produce the cars. You would need to break into a very small group of competitors. You know, there's Ford, there's General Motors, there's Toyota, and there's a small group of very strong players already in the market. So it would be much more difficult for you to get into that industry. And so when we talk about ease of entry, what we're asking is how easy is it to get in? How easy is it to get out of the industry? Now you might say, how could it be difficult to get out of a business? Well, a lot of companies produce products and have a lot of capital infrastructure, and for them to shut down is an expensive process as well. For example, in El Paso, we had Asarco, and Asarco was a copper refinery company, and the price of copper went down, but the company did not close. They kept their operations on at a very low level. So eventually they did close, but the cost of getting out of that business was quite high because they had to do some environmental cleanup. They had to tear down the smokestacks. So it was a very expensive proposition. There are some examples of barriers to entry. Equipment cost. So remember that equipment is capital. The size of other competitors. So if you wanted to get into an auto industry, the big competitor there, of course, would be the auto companies. They're already big. They already have the market or a lot of customers. Another barrier to entry for firms is ownership of resources. Maybe you want to produce something, but you don't have a key resource that is needed, so you cannot get into that industry. And then we have legal barriers such as patents, copyrights, and franchises. So all of those are things that make it difficult to get into a business or into an industry. Now, I do want to define for you the difference between an industry and a firm. An industry is a grouping of firms that produce a similar product, like the auto industry, and then you have the companies like Ford, General Motors, Toyota. Okay, so that would be an industry, is the big general category, and then the firms underneath it are the separate companies. And we have a lot of different industries. We have the retail clothing industry. We have the food industry. If you talk about the food industry, underneath that you have Kraft, you have Kellogg's, you have General Mills, and other companies that are part of that food industry. Okay, so we have 4 market structures that we're going to talk about. The first one is going to be pure competition. Then we're going to talk about monopolistic competition, oligopoly, and pure monopoly. Now note I have this bracket here that says these 3, monopolistic competition, oligopoly, and pure monopoly, are forms of imperfect competition. Now I think it's super important to understand that we're going to start with this construct of pure competition, but importantly, pure competition is actually more theoretical in nature. Very few firms and industries are purely competitive. We study pure competition because it provides us a basis to analyze the other types of industries, and it is most representative of small businesses. And we can look at how the small businesses operate better if we use a pure competition model, perhaps a monopolistic competition model. So our discussion is going to start here with pure competition, and then I'm going to go to the extreme of pure monopoly, and then we'll talk about these 2 industries in between. Okay, so each market structure has some key characteristics. And recall that I said that we're going to look at these based on the number of buyers and sellers. So in this case, the characteristic, we're going to look at number of firms. Types of product. Conditions of entry. That means, is it easy to get into or not easy to get into? Ease of entry. We're going to look at how they compete with each other, and then some examples. So right here, pure or perfect competition is a very large number of buyers and sellers. The product that they sell is standardized. You will also hear the word homogenized. And what that means is that you can't distinguish one company's product from the next company's product. It's exactly the same. In terms of the control over the price, a perfectly competitive firm operating in perfect competition has no market power, which means they can't really decide what price to sell their product at. And we'll go into the details of that in a little bit. Conditions of entry, it's very easy. There are no obstacles in perfect competition. And because there are no obstacles, that's pretty much why we have a large number of sellers. Non-price competition, there is no competition in perfect competition. And that is the weirdest thing to wrap your head around. We're used to hearing that term competition, and companies are out there competing with each other, and they are, putting advertising, and they're trying to get your dollar. In pure or perfect competition, none of that exists. And the reason is because there are so many companies and so many buyers that competing makes no sense, because nobody has market power and every single company just has a sliver of the customer base. Okay. So an example, traditional example, is agriculture. We can't really tell one apple from another, one grain of rice from another. So agriculture is a typical perfectly competitive example. Okay. Now, I want to jump from pure competition over to monopoly. Okay. So monopoly is at the other extreme. So under monopoly, we have one seller, not many sellers. So this one seller provides a unique product. So come over here, type of product. It's a unique product with no close substitutes. So an example of that would be the electric company, an electric utility. In our community of El Paso, we have one seller of electricity. And electricity is unique, not very many, if at all, substitutes for electricity. How much control do they have over the price? Well, a monopoly can have considerable control over the price. They can charge, theoretically, whatever they want to. For example, another type of monopoly is De Beers diamonds. So De Beers is one of the key providers of diamonds in the market, and they can set whatever price they want for that diamond. So they have a lot of market power. Now, in the case of the electric utility, because electricity is a needed, inelastic demand, right? Everybody needs electricity. There is regulation of electricity. So if the electric company, for example, wants to raise rates, they have to go to the Texas Utility Commission to get approval on that. And there is government regulation to ensure that the monopoly does not overcharge the community for electricity. But generally speaking, a monopoly will have considerable market power over the price that it charges for its goods and services. Now, let's look at conditions of entry. Blocked. There are a lot of barriers to entry. Again, barriers to entry means that it's difficult to get into the market. In terms of competition, well, if they're the only provider, they pretty much don't have competition, right? There's nobody to defend their product against. And most of the advertising you're going to see is going to be public relations advertising about their contribution to the community, how they are volunteering their time in the community. You'll see more advertising having to do with just public relations and trying to keep a good presence. And again, local utilities is the most predominant example. So here we have these two extremes, and then we have these two structures here that are kind of a blend. Okay, so let's start with oligopoly. Oligopoly is one that we are most used to hearing about. This is 2 to 10 sellers. Okay, so we have Airbus and Boeing, our key airplane manufacturers, Coke and Pepsi, Walmart and Target. Again, the auto industry. There's Ford, there's General Motors, I think there's Chrysler, Toyota, Nissan. This is more of a global market. So there's a few sellers. The type of product that they produce can be standardized or differentiated. Oh, incidentally, another type of oligopoly would be your cell phones, right? We have Apple and Samsung, and maybe LG produces a cell phone. That's an oligopoly. Cell phone service providers, T-Mobile, Verizon, AT&T, those are oligopolies. Okay. So the type of product they produce can be standardized or slightly differentiated. Okay. So again, remember, standardized means it's the same, it looks the same, it acts the same, it provides the same function. Differentiated means that there's something about it that makes it better, or the companies are trying to distinguish their product from somebody else's product. Okay. Control over price. Limited control over price. Well, actually, I take that back. I was reading the wrong one. So control over price is limited because the companies are mutually interdependent. Okay. So when I say mutually interdependent, what I mean is, and you see this all the time, if Coca-Cola has a sale at the Albertsons, the next week Pepsi's going to have a sale at the Albertsons. They watch each other to see what the other is doing in terms of pricing, in terms of advertising. So they are mutually interdependent. Now, do they actually talk to each other? Do they get on the phone and talk to each other? No, they do not do that. But because they're looking at each other's advertising and what's going on, they are kind of basing their strategy on the other company's strategy. So there's some collusion, but it's not actual collusion where they're calling each other. What they're trying to do is see what the other one is doing. Another example of this was when Target and Walmart would price match each other. So whatever I do as a company is going to be copied by the other company. So in that sense, they are mutually interdependent. Okay. Conditions of entry, significant obstacles. There are barriers to entry. The barriers to entry are similar to those in monopoly, mostly having to do with the size of the company and having to do with the market share. How many customers do they have? Okay, so it's hard to get into an industry when it's the market share for one company is already very large. Another example of an oligopoly, for example, is ADM and Intel, and they make the processors for computers. So that is an oligopoly as well. Non-price competition. Competition among oligopolies typically has to do with product differentiation. How is my product better than my competitors? Okay. How is it that Coca-Cola is better than Pepsi? How is it that Nike is better than Reebok? And they position themselves, and that this is where you're going to see advertising and a lot of the trying to distinguish their product from the other one. Examples: steel, auto, and farm implements. Monopolistic competition is a hybrid of pure competition and monopoly. There's many buyers and sellers. The type of product they sell is differentiated. Control over the price. They have some control over the price for a short period of time. And the time period is going to be much less because why? There are many buyers and sellers in the market. So as soon as one company starts to have a profit and can control the price, another company is going to see that it's a profitable venture, and then they're going to enter the market, and then the pricings, they begin to have little price wars. Conditions of entry are relatively easy, and in terms of competing, they compete based on advertising, brand names, and trademarks. And big examples of this are retail trade, dresses, shoes, a lot of this where there's a lot of competition and you see a lot of advertising, and you open up a magazine, especially some of the fashion magazines, you can see a lot of advertising from competitors. So this is monopolistic competition. Okay, so we're going to go into more detail on perfect competition. And first, I'm going to give you an intuitive approach so that you can kind of think about this. Then we're going to look at a numbers approach, and then we'll work out a problem. So, pure competition. In a perfectly competitive industry, we have a very large number of sellers. We have also a very large number of buyers. We have a standardized product. Individual firms are price takers, which means they have no market power. and there's easy entry and exit. Now, I want you to recall our demand curve and our supply curve. Remember, we talked about how perfect competition gives us maximum consumer surplus and maximum producer surplus. So I just want you to keep that in your memory banks because we will be pulling on that concept later on. Okay. So profit is the main motive for a firm's action. And the question becomes, well, how do firms maximize their profit? So one of the questions we need to think about is, how do firms, individual companies, behave under a market structure of perfect competition, and what is their goal? So profit is the main motivation for a firm's actions. Now, we could say that, not all firms are profit driven, but for the most part, if a firm isn't profitable, it's probably going to go out of business. So we're going to operate under the assumption that profit is the main motivation for a firm's actions. The question then becomes is, how do firms maximize profit? By choosing the price to charge and how much to make. Now, in a perfectly competitive structure, there is no choice about how much to charge. It is the market that is going to set the price. So quantity is going to be the key choice that determines profitability for the firm. So the competitive firm. Recall that the competitive firm sells a product that is homogeneous or standardized. So let's think about enchiladas. Okay, so here in El Paso, under normal conditions, almost every single restaurant or every single Mexican restaurant sells enchiladas. Red cheese enchiladas are pretty much the same all over the city. And there are many buyers and sellers of enchiladas. So we want to look at what price should be charged. Okay, so we're going to look at first the supply and the demand for enchiladas across the city. So that is our market. Okay, so we have the demand for enchiladas and we have the supply of enchiladas. So we call this market supply and this is called market demand. The point where they intersect right here is our equilibrium price. Right? That's the price you're going to have to pay when you go to the restaurant. So let's assume that it intersects here at $6.50 a plate. And 5,000 plates of enchiladas are sold. So if you decide to open up a restaurant, what price do you have to charge for your enchiladas? Can you go out there and charge $12 for the same enchiladas that somebody else is selling for $6.50? Well, probably you can charge whatever you want, but you're probably not going to sell it. Okay, so if you are going to start your own restaurant business, then what's going to happen is that you're going to have to charge what the market price is. So if all buyers and sellers agree that $6.50 is the price, well, guess what? Your company, your restaurant, is going to have to charge $6.50. So in this sense, we say that the individual firm has no market power. They have no control over the price. The demand for your enchiladas will be perfectly elastic at the market price. Okay, so demand equals the market price. And pretty much we have to charge that. Why? Well, if we want to charge more, let's say we want to charge $7, no one's going to buy this if you charge $7 because you can get the identical enchilada somewhere else at a lower price. If you charge less, say $5, you can sell as much as you want, but that wouldn't make sense because you could actually sell it for $6.50 and you'd be losing money. So for a firm operating under perfect competition, the market price sets the price that you have to sell your product for. Okay, so just to recap, now why can you sell enchiladas, all the enchiladas you want at $6.50? I mean, that might be a good question. The reason you can sell as many enchiladas that you want at $6.50 is because there are so many sellers in the market that your production compared to the overall market is small and it does not influence the overall price. So here's the notes you should take. What price should you charge if you are in a competitive market? You're going to charge the market price. You have no control over price setting. And because you have no control, this is called no market power. Now, I know that somebody out there is thinking, well, but wait a minute, what if I sell red chicken enchiladas? Or what if I make green enchiladas? Okay, so if that's what you're thinking, what you have done in your head is you have differentiated your product. You've made your product slightly different. Okay, but for purposes of our conversation right now, we're making the assumption that we are only talking about red cheese enchiladas. Okay, so it's a homogeneous, standardized product. The minute you can differentiate your product, then you've moved into perhaps monopolistic competition. So remember our attributes, okay? But for purposes of this conversation, we're just talking about red cheese enchiladas. Okay, so let's take a look at these little practice questions. A competitive firm maximizes its profit by doing what? Well, we just said that a competitive firm has no control over its price. That pricing is based on the market price. So automatically, A is out. A competitive firm has control over quantity. Well, I just said that it has control over quantity. Both price and quantity. No, that would not be true. Either price or quantity, but not both. Well, that's like not making a decision. You don't really know the answer there. And none of the above. No. So the correct answer here is quantity. Okay. A competitive firm only has control over quantity. A competitive market has which of the following characteristics? So we talked about this already. Lots of small-scale sellers, lots of small-scale buyers, a product that is similar across all sellers, so that's your homogeneous product, so that's a yes. A and C only? A and C only, no, because it has a lot of small-scale buyers as well. So the answer to this one is going to be, well, it's going to be all of the above. Okay. In a competitive market, sellers sell their product at the world price, below the world price, just above the world price, at a price dependent on the quantity chosen. Okay, so we just finished saying that a competitive firm is going to sell at the market price. So what does that mean? A world price is a world market price. So a competitive firm is going to sell at the world price. So here's a funner question. And it'll be interesting to see if you guys can figure this out. Okay. And after I read the question, stop a minute, stop the video, see if you can figure it out, and then check to see if you're right. So on January 27th, 2011, the price of Ford Motor Company stock hit an almost 10-year high at $18.79 per share. 2 years prior, in January 2009, Ford stock was trading for about a tenth of that price. So that's a big gain, right? Suppose that on January 27th, 2011, you owned 10 shares of Ford stock. And that's 10,000 shares, sounds like a lot, but there's 3.8 billion shares of stock outstanding. So you own like a very little piece of that. Suppose you offered to sell your stock for $18.85 per share. just slightly above the market price. How many shares would you sell? Okay, so stop the video, look at the problem, and think about it for a moment. All right, so what did you decide? How did you figure this out? Well, let's take a look at this. It says in 2011, January 27th, 2011, Ford Motor Company stock hit a high of $18.79 per share. Okay, so what that is telling you is that there was a market. Oops. So what that's telling you is that there was a market for Ford stock. And recall that I always want you to start with a supply curve and a demand curve. And it tells you that the equilibrium price was $18.79. Okay. You own 10,000 shares and you want to sell these for $18.85. So you, in a sense, are like an individual firm. So you are an individual firm, which means then, theoretically, you should be charging $18.79 for this. But what are you asking for? You are now over here, and you are asking for $18.85 a share. You're asking for more. And the question is, will you be able to sell it? How many shares will you sell? Okay. And so guess what? If you're asking for more than the market price, you're not going to sell anything. So the correct answer to this is 0. Okay, so if you ask more than the market price, no one's going to buy it from you. Okay, now suppose instead that on January 27th, 2011, you wanted to sell your 10,000 shares of Ford stock, but you reduced the asking price to $18.75 a share. How many shares would you sell? Okay, so now we're going to $18.75, and the market price is $18.79. Whoops, sorry. So how much are you going to sell? Well, you're asking now for less. You're asking for $18.75. Sorry, those lines are really wrinkly. So you're going to sell all of your stock. Okay. So given your answer here, do you think you should sell your shares at $18.75? And the answer is no, because the going market price is $18.79. Let's continue with perfect competition. So the key question for a firm operating in perfect competition is not what price to charge, but the question is how much to produce or how much to make. As an individual firm in perfect competition, the only things that you have control over are how much to produce, the quantity to produce, and your costs. So we talked about costs in the previous section, and now we're going to focus on quantity to produce. So we want to maximize profits. And we know that profits are equal to total revenue minus total cost. So now you're going to want to write this down. You need to absolutely, positively memorize this formula. In terms of quantity to produce, what is the goal of the firm? The goal of the firm is to maximize profit. So how do we define profit? Profit is total revenue minus total cost. So this is a formula that you need to jot down in your notes. Profit equals total revenue minus total cost. How do we find total revenue? We take the price of the product times the number of units sold. So that's price times quantity. If you're on accounting, this is your sales top line on your income statement. Total cost is our fixed cost plus our variable cost. So recall that fixed costs are costs that do not vary with output, and most typically this would be equipment. So if we look at the picture over here, this burner here, the equipment, the extractor, all of that does not vary whether you make 1 plate of enchiladas or 1,000 plate of enchiladas. It's still the amount that you paid for this piece of equipment stays the same, for example. Okay. Then we have variable cost, and variable cost does vary with output. It's things like labor and ingredients, and those are varying as output changes. Then don't forget that we talked about opportunity cost in our last section, and how opportunity cost or implicit cost are also costs. So how much should we make? That's the key question. For each plate of enchiladas we make, we know that when we sell it, there's going to be additional revenue, additional sales. We call additional revenue marginal revenue. Okay, so marginal revenue is the addition to total revenue from selling one more unit or one more plate of enchiladas. We also know that if we make another plate of enchiladas, we're going to incur additional cost. And additional cost is called marginal cost. Marginal cost is the addition to total cost from producing an additional unit of output. So these are two things that you need to memorize: marginal revenue, marginal cost. Profit maximization is about comparing how much marginal or additional revenue we're going to get by making and selling one more plate of enchiladas and comparing that to the cost of preparing one more plate of enchiladas. So we're going to be looking at how much money are we bringing in, and we're going to compare that to how much it's costing us to produce that additional plate of enchiladas. And profits are going to be maximized where the additional revenue is equal to the additional cost, where marginal revenue equals marginal cost. So let's look at this graphically. Okay. Profit maximization under perfect competition. Now, we know that at $6.50, we can sell as many plates of enchiladas as we want, right? Now, don't forget that the firm's output is on the x-axis and the price that we're charging is here. So if we draw in our marginal cost curve, again, this green line is the price that we have to charge. So our demand curve is equal to our price is equal to marginal revenue. Our marginal cost curve, as we saw in the last chapter, is the addition to cost due to the addition of output, to the change in output. So marginal revenue equals marginal cost is where we're going to maximize our profit. Note here, if marginal revenue is bigger than marginal cost, you're not maximizing your profit. So if you are producing over here, for example, you could continue to produce, and you should produce more, because right now $6.50 marginal revenue is greater than what it's costing you to produce each additional plate. So you're going to keep producing up until the point where these two lines intersect. Now, beyond this point, what happens? You can see the blue line is higher than the green line. Our marginal cost is bigger than our marginal revenue, and you should produce less. So this becomes the optimal point. Optimal meaning the profit maximizing point of output. This is how many units you should produce, and that is going to be what maximizes your profit. So here's some rules of thumb to remember. Marginal revenue, when marginal revenue is larger or bigger than marginal cost, you're not maximizing your profit. You want to increase your production up to the point where marginal revenue equals marginal cost. If marginal revenue is less than marginal cost, you need to produce less. You need to cut back on production to increase your profits. And this is your point of profit maximization. Okay, write this down. Okay, this needs to be in your notes and in your brain, so make sure you know this. Okay, so now we know how much to produce. We know we have to produce 30 plates of enchiladas to maximize our profit. But we still haven't found our profit. And now we're going to look at how do we find profit. Okay, well, we have to put in our cost per unit. Recall that average total cost means our per unit cost. So now we know that it's $6.50 per plate of enchiladas. Now we want to know what is our per unit cost per plate of enchiladas. And we need to draw that in. So what we do then, here's $6.50. Here is where marginal revenue equals marginal cost. We're going to drop a line. This is how you're going to read it graphically, so learn how to do this. You're going to drop the line to the average total cost. And so now we see that for 30 plates of enchiladas, we are hitting our average total cost curve right here. We take this across to the vertical line, and it tells us that it is costing us $4.75 per plate for each plate of enchiladas that we produce. So we are selling these for $6.50, and it's costing us $4.75. So we have to figure out what is our profit. Okay, the profit is going to be this entire area. Okay. So here's our formula. Profit equals price minus average total cost times the number of units being produced. So let's look at this. Price of $6.50 minus average total cost, that's $4.75, times the number of plates being produced, that's 30 plates. So $6.50 minus $4.75 times 30 plates gives us a profit of $52.50. Okay, so you might be saying, well, wait a minute, didn't you just say that profits is total revenue minus total cost? Yes, but remember from algebra, we can rearrange the variables. Okay, recall that total revenue is price times quantity, right? And total cost is average total cost times quantity. So we can break this up. Profit equals, if we do price times quantity, that gives us our total revenue. If we take average total cost times quantity, that gives us our total cost. Okay, so this is merely another way of saying the same thing. Let's consider what happens if the market price goes up. If the market price goes up, this means that you can now charge the market price. The market price goes up to $7.50. How much will you produce? Well, again, we will be following our profit maximizing rule. We will produce where our new marginal revenue, which is now $7.50, is equal to our marginal cost. And we will be producing 40 units of output. We'll layer on our average total cost curve, and we will see that at 40 units of output, average total cost is going to be $5. Average total cost will be $5. And our profit will be $7.50 minus $5, gives us $2.50, times 40 units, and that shows us that our profit will be $100. Now, on the flip side, what happens if the market price goes down to below the average total cost? Let's say people don't like enchiladas for whatever reason, demand drops, shifts to the left, the price of the market enchilada goes down to $3. First question is, when that happens, what happens to our price that we have to charge? Well, we know that if the market price goes down, our firm has to charge less. So we will charge the market price of $3. And we will produce where marginal revenue, this is now our new marginal revenue because price equals marginal revenue in perfect competition. And we will produce 25 plates of enchiladas. Let's layer on our average total cost curve. And in this case, you can see that for us to produce 25 enchiladas, our costs are going to be higher than the price that we're getting. So intuitively, you know that we will be suffering some losses. We're going to find losses the same way we find profit. We're going to take price minus our average total cost, and that will give us the amount of our loss. So our price was $3. The average total cost is $4. So 3 minus 4 gives us -1 times 25 plates of enchiladas being produced. That gives us a -25, which means that at a price of $3, we are operating at a loss. So then the question is, well, if you're operating at a loss, should you continue to produce? And here's a general rule. As long as the price is greater than the average variable cost, you should continue to produce in the short run. So this is our previous slide. And now we are going to introduce the average variable cost curve. And recall that this is our labor and our variable inputs. Okay. Now you can see that at 25 units, we draw our little dotted line up to the average variable cost curve. We're looking at cost at around $1. So our cost for 25 units for average variable cost is $1. Our average total cost is $4. That means that this spread right here is our average fixed cost. Okay, so recall that the spread between your average total cost and your average variable cost is your average fixed cost. Okay, so by continuing to operate, even though we are experiencing some losses, we are able to cover a portion of our average fixed cost. Okay, so selling 25 plates of enchiladas at a price of $3 covers at least $2 of our average fixed cost. So 3 minus 1 is 2. We're covering $2 of the fixed cost associated with the production of our enchiladas. We are losing $1 per plate of enchiladas. So when we look at our chart, we can see that we are covering $50 worth of our fixed cost, our total fixed cost. On a per plate basis, we're covering $2. We're producing 25 plates. That means that we're bringing in $50 that can go for covering our expenses. So to recap, our average fixed cost when we are producing 25 plates of enchiladas is $4 minus $1. So our average fixed cost associated with 25 plates is $3. By continuing to sell at the market price, which coincidentally is $3 as well, we are at least covering $2 of our fixed cost. In accounting, I believe they call this the contribution margin. So then this blue rectangle becomes the amount of revenue that we are bringing in that will go to cover our fixed cost. Now, the next question is, what happens if the market price drops below the average total cost curve and is right at $1 a plate? Should we continue to produce? So we'll introduce our curves again. Okay. At this point, the price of our product has dropped to $1. At $1, this is our new marginal revenue curve. We're going to produce where marginal revenue equals marginal cost, and that is going to be right here at 20 plates of enchiladas. So as you can see, at this level, we're not even covering our average fixed cost, but we are covering our average variable cost. Okay, so this is average variable cost when we produce 20 plates of enchiladas is $1. So this is how much it's costing us to cover our workers and our ingredients, for example. So should we continue to produce, or what should we do? So at this point, you are incurring losses. You are incurring losses to the tune of, let's see, the price is $1, and it's costing you $4.25 per plate to produce. So you are losing $3.25 a plate. Times 20, that's going to give you $65 worth of losses. So should you continue to produce? And it depends. Right now, you can cover your variable cost, but the question becomes for how long? So a lot of this is going to be depending upon what you think is going to happen in the future. And this is where your economic analysis comes in. If you think prices are going to go up, you might be able to hold the fort down for a while and keep your business going. If you anticipate that business conditions are going to decrease, you might be at a shutdown point. In any case, if you decide to shut down, your loss is going to be equal to the total amount of your fixed cost. So basically, this is a big question mark. What should you do? Should you stay in business? So when price equals average variable cost, the decisions are: 1, do I shut down? 2, do I stay in business in the short run and wait for market prices to go up? How can I reduce my costs to lower my costs? And that might allow me to stay in business. So these are things that we have to decide. So this is kind of a wait and see sort of game, or you can just decide to shut down. So it's important to know that shutting down in the short run does not mean that you shut down forever. Prices can be low on a temporary basis. Some firms switched their production to producing something else. Maybe enchiladas aren't selling. Maybe you should be selling, some other type of product. So it depends upon the market price of the product. And firms that often do this are firms like oil producers, resorts, some companies that shut down during a recession then open up during an expansion. Okay, now, what happens if the price drops below $1? Well, that is an easy choice, because if the price drops below $1, you will not be covering any of your costs. And if you're not covering any of your costs, then you should shut down. So anytime the price is less than the average variable cost, it's a shutdown. And the amount of your loss will be the amount of your fixed costs. Okay, so here are some questions. Should the firm produce if the price is equal to or greater than the minimum average variable cost? The firm is either A, getting some profit, or B, its losses are less than its fixed cost and it can continue to operate. How much should the firm produce? So the profit maximizing output level is wherever marginal revenue equals marginal cost. This point will maximize your profits and it will minimize your losses. Finally, will production result in economic profit? As long as price exceeds average total cost, as was the case when our product was $7.50, we will be having what is called an economic profit. So here's an attribute of perfect competition. In perfect competition, the marginal cost curve becomes the supply curve. You can see that as prices go up in the market, the quantity supplied by the seller increases. So the marginal cost curve is the supply curve under perfect competition. As prices increase, quantity supplied increases. And to summarize, recall that the firm must charge the price that is the industry equilibrium. In the long run, because of the attribute of easy entry and exit, the long run competitive equilibrium price is going to be right where price is equal to the demand curve, equal to the marginal revenue curve, and equal to your average total cost curve. So price equals marginal revenue equals a demand curve equals average total cost. That is your long run equilibrium price. Okay, take a break.